Hello everyone, welcome to the 117th episode of me learning how to trade in Forex. So in the last episode we finished off see how leverage can quickly wipe out your account. So looking at true leverage is basically the full value or also known as notional value of all your positions divided by the amount of money deposited in your trading account. So I went through an example with that. So if you buy one standard 100,000 of Euro USD at a rate of $1, the full value of your position is 100,000 and your account balance is 10,000. True leverage is 10 to 1 because this is 100,000 of your full value divided by your account, the money deposited in your trading account. If you buy another 100,000, then your true leverage goes up to 20 because it's 200,000 now divided by 10,000 instead of the 100,000. If you buy another 300,000, you become 500,000, so it's now 50 to 1. So in order to receive a margin call, the price would have to move 100 pips. So that will mean the price of Euro USD will have to move from 1 to 0.99. A price change of 1%. So that is assuming the broker requires a 1% margin, so you would lose 5,000 or 50% of your account and the price only moved 1%, which is insane. So if you had 100,000 and instead of 10,000, so if you used 100,000 to buy the same 100,000 position, your true leverage would then be 1 to 1 because you're using 100,000 of your money to buy 100,000 of the position, so you're not really leveraging anything. That makes you much safer from margin calls because where is this? The price would have to move 9,900 pips in order to get margin calls. So this is a price change of 99% or basically 100%. So very good there. But if you buy 19 more standard lots, that's where the risky business comes in. So you would only get a price change of 4% and then you'll get a margin call, and then you would lose 80,000 of your $100,000 account balance, which is kind of mad. You would have wiped out 80% of your account and the price only moved 4%. So you would be screaming. So leverage amplifies the movement in the relative prices of a currency pair by the factor of the leverage in your account. So that's that. And now we're on to low leverage allows new Forex traders to survive. So low leverage allows new Forex traders to survive. So low leverage allows new Forex traders to survive. As a trader, it is crucial that you understand both the benefits and the pitfalls of trading with leverage. Using a ratio of 100 to 1 as an example means that it is possible to enter into a trade for up to $100 for every $1 in your account. With as little as 1,000 of margin available in your account, you can trade up to 100,000 at 100 to 1 leverage. This gives you the potential to earn profits on the equivalent of a $100,000 trade. It's like a super scrawny dude who has a super long forearm enter an arm wrestling match. If he knows what he's doing, it doesn't matter if his opponent is Arnold Schwarzenegger. Due to the leverage that his forearm can generate, he will usually come out on top. When leverage works, it magnifies your gains substantially. Your head gets big and you think you're the greatest trader that ever lived. But leverage can also work against you. If your trade moves in the opposite direction, leverage will amplify your potential losses. So leverage can work against you if your trade moves in the opposite direction leverage will amplify your potential losses. You'll be broke faster than Mike Tyson can chew your ear off. Here's a chart of how much your account balance changes if price move depending on your leverage. So if you've got 100 to 1 leverage, changing currency pair 1%, changing account 100%. Damn. So if you've got 50 to 1 leverage, if the change in currency pairs 1%, 50% change in your account. So as the leverage goes smaller, we can see that the changing account also goes smaller as well, if using the same 1% in the change currency pair. Let's say you bought USD JPY and it goes up by 1% from 120 to 121.2. If you trade one standard 100,000 lot, here is how leverage would affect your return. Leverage 100 to 1 margin required 1,000. Percentage change your account plus 100%. So you would double your account. To the other extreme end, if you're using the true leverage, or not true leverage, just no leverage basically, your true account money, it's 100,000, you only gain 1% because it goes up 1%, so 1% of 100,000 is only 1,000, so yeah. So basically, you can basically do this trade, but with only using this. Let's say you bought USD JPY and it goes down by 1% from 120 to 118.6. If you trade one standard lot, 100,000 lots, here's how leverage would affect your return or loss. So if you do 1,000, you just basically blow your account, you got nothing left. Whereas if you do 100,000, you only minus 1%, so you only lose $1,000. The more leverage you use, the less breathing room you have for the market to move before a margin call. More leverage used, the less breathing room you have for the market to move before a margin call. You're probably thinking, I'm a day trader, I don't need no stinking breathing room. I only use 20 to 30 pip stop losses. Okay, let's take a look. Example number 1. You open a mini account with $500 which trades 10,000 mini lots, only requires 5% margin, or 0.5% margin. You buy 2 mini lots of Euro USD. Your true leverage is 40 to 1 because your total notional value is 20,000. Because you're buying 2 mini lots, so 2 times 10,000 using your $500 in your account. So your true leverage is 40 to 1. You place a 30 pip stop loss and it gets triggered. Your loss is $60 because $1 per pip times by 2 lots. You just lost 12% of your account, $60 loss over your $500 account. Your account balance is now $440. You believe you just had a bad day, the next day you're feeling good and want to recoup yesterday's losses, so you decide to double up and you buy 4 mini lots of Euro USD. Your true leverage is about 90 to 1 now. You set your usual 30 pip stop loss and you trade losses. Your loss is $120. You just lost 27% of your accounts, 120 loss over 440 accounts. Your account balance is now $320. You believe the tide will turn, so you trade again. You buy 2 mini lots of Euro USD. Your true leverage is about 63 to 1. You set your usual 30 pip stop loss and lose once again. Your loss is $60. You just lost almost 19% of your account. $60 loss over $320 of accounts. Your account balance is now $260. You're getting frustrated. You try to think about what you're doing wrong. You think you're setting your stops too tight. The next day, you buy 3 mini lots of Euro USD. Your true leverage is 115 to 1. You loosen your stop loss to 50 pips. Your trade starts going against you and it looks like you're about to get stopped out yet again. But what happens is next is even worse. You get a margin call. Margin called. Since you opened 3 lots of $260 account, your used margin was $150, so your usable margin was a measly $110. The trade went against you 37 pips, and because you had 3 lots opened, you get a margin call. Your position has been liquidated at market price. The only money you have left in your account is $150, the used margin that was returned to you after the margin call. After 4 trades, your trading account has gone from $500 to $150, a 70% loss. Congratulations, it won't be very long until you lose the rest. Oof. So that's the 4 trades. A 4 trade losing streak is not uncommon. Experienced traders have similar or even longer streaks. The reason they're successful is that they use low leverage. Low leverage. Most cap their average leverage at 5 to 1, but rarely go that high and stay around 3 to 1. Most cap their leverage at 5 to 1, but rarely go that high and stay around 3 to 1. So only 3 times the amount in your account balance. The other reason experienced traders succeed is that their accounts are properly capitalized. While learning technical analysis, fundamental analysis, sentiment analysis, building a system, trading psychology are important, we believe the biggest factor on whether you succeed as a forex trader is making sure you capitalize your account sufficiently and trade that capital with smart leverage. So ensure you capitalize your account sufficiently and trade that capital with smart leverage. Your chances of becoming successful are greatly reduced below a minimum starting capital. It becomes impossible to mitigate the effects of leverage on too small accounts. Low leverage with proper capitalization allows you to realize losses that are very small, which not only lets you sleep at night but allows you to trade another day. Low leverage with proper capitalization allows you to realize losses that are very small. Which not only lets you sleep at night but allows you to trade another day. Example number 2. Bill opens a $5,000 account trading 100k lots. He is trading with a 20 to 1 leverage. So he could trade up to 20 times 500, he could trade up to 100,000. The currency pairs that he normally trades move anywhere from 70 to 100 pips to 200 pips on a daily basis. In order to protect himself, he uses a type 30 pip stop loss. He uses type 30 pip stops. If prices go 30 pips against him, he will be stopped out for a loss of $300. Bill feels that 30 pips are reasonable, but he underestimates how volatile the market is and finds himself being stopped out frequently. After being stopped out 4 times, Bill has had enough. He decides to give himself a little more room, handle the swings, and increase his stop loss to 100 pips. Bill's leverage is no longer 20 to 1. His account is down to 3,800 because of his 4 losses at $300 each, and he's still trading 100k lot. His leverage is now 26 to 1. He decides to tighten his stops to 50 pips. He opens another trade using 2 lots, and 2 hours later his 50 pip stop loss is hit and he loses $1,000. He now has $2,800 in his account. His leverage is over 35 to 1. He tries again with 2 lots, This time the market goes up 10 pips, he crashes out with a $200 profit. His account grows slightly to 3,000. He opens up another position of 2 lots, the market drops 50 points and he gets out. Now he has $2,000 left. He thinks, what the hell, and opens another position. The market proceeds to drop another 100 pips. Because he has $1,000 locked up as a margin deposit, he only has $1,000 margin available, so he receives his margin call and his position is instantly liquidated. He now has $1,000 left, which is not even enough to open a new position. He lost $4,000 or 80% of his account for total of 8 trades, and the market has only moved 280 pips. 280 pips, the market moves 280 pips pretty darn easily. Are you starting to see why leverage is a top killer of Forex traders? As a new trader, you should consider limiting your leverage to a maximum of 10 to 1, or be really safe 1 to 1, so only trading what you have. Don't trade any more than what you have in your account. Trading with too high leverage ratio is one of the most common errors made by new Forex traders. Until you become more experienced, we strongly recommend that you trade with a lower ratio. New traders should consider limiting leverages to a maximum of 10 to 1. Ideally using a leverage of 1 to 1, so no leverage at all. I'm not feeling well, I better deleverage. True. With too high of a leverage ratio is one of the most common errors made by new Forex traders. So, how leverage affects transaction costs. Besides amplifying your losses, leverage also has another way of killing you. It's a much slower kind of death though, kinda like dying by 1,000 cuts. Most Forex traders don't see it coming, and by the time they notice it, they're dead. This killer we're talking about is the associated transaction costs of using high leverage. Not only does leverage amplify your losses, but it also amplifies your transaction costs as a percentage of your account. Leverage also amplifies your transaction costs as a percentage of your account. These transaction costs are killing me. Let's say you open a mini account with $500. You buy 5 mini 10k lots of GBP USD, which is a 5 pip spread. Your true leverage is 100 to 1 because you're buying 50,000 worth of total mini lots and you only have a $500 account. But check this, you paid $25 in transaction costs. $1 per pip times a 5 pip spread, and there's 5 lots. That is 5% of your account. With one trade and the market not even moving yet, you're already down 5%. If your trade loses, your account balance shrinks. As your trade account balance shrinks, your leverage increases. As your account balance shrinks, your leverage increases. As your leverage increases, the faster your transaction costs eat away at the little money you have left. This is the slow and silent killer I'm talking about. As your account decreases, account balance decreases, your leverage increases. As your leverage increases, the faster your transaction costs eat away at the little money you have left in your account. This is a slow and silent killer I'm talking about. The higher leverage, the higher your transaction cost as a percentage of your trading capital. The higher your leverage, the higher your transaction cost as a percentage of your trading capital. This is why transaction costs are one of the 6 most important factors when choosing a broker. For example, if you go long 10,000 units of Euro USD with a 5 pip spread, which equals $5 transaction cost, look at how the relative value of your transaction costs increase with more leverage. Leverage 200 to 1, 200 to 1. Margin required $50. Cost as a percentage of margin required 10%. So as your leverage decreases, your margin required increases. However, the cost as a percentage of margin requirement also decreases. Now you've learned how leverage can magnify your profits and losses, but also your transaction costs. So, decreasing leverage increases the margin requirement, however, also decreases the cost as a percentage of margin requirement. Required. Now you've learned how leverage can magnify your losses, profits and losses, but also your transaction costs. Leverage does not equal margin. Leverage is how many times you lever your whole account. The maximum amount that you are allowed to lever is dependent on your margin requirements. Never underestimate leverage. Most beginners underestimate the potential devastating damage leverage can wreak on their accounts. Understanding leverage enough to know when to use it and when not to use it is critical to your success. Don't get greedy, watch your leverage, son. Leverage is a very powerful tool, but both old and new traders use it to destroy their trading capital simply because they take its destructive force too lightly or ignore it altogether. It's a pity, but the more of them there are, the easier it is for us smart traders to make money. Sad but true. Always keep in mind these words from a famous superhero. With great power comes great responsibility. Or something to that effect. Come on, we know you've seen that movie. Here's a clue. Spider-Man. Get it? Anyway, high leverage is a favorite selling point for most Forex trade brokers. Yes, they pitch that they can make a huge killing using huge leverage, but also know that you could easily be killed by huge leverage as well. Most brokers want you to trade with a short-term mindset. They want you to trade as much as possible, as often as possible. It's the only way they make money. 1 or 2 pips are important to them. The more you trade, the more they make on the spreads. It's not in their best interest to tell you to let your trades run longer than the same day. If you want to give yourself the best chances to succeed, first learn to trade profitably without leverage. Learn to trade profitably without leverage if you want to succeed. Succeed. learn to first learn to trade profitably without leverage if you want to succeed. Play it safe, protect your capital. When you can consistently make more pips, more than you lose them, and only then should you unleash this weapon of mass destruction called leverage. Destroy traders taking the opposite side of your trade. Don't destroy yourself. True. Forex trading should be treated as a job or business. Don't think that just because brokers allow you to use high leverage with a low minimum deposit that you can make it quick or get rich quick. Approach the currency markets with respect. Be realistic in your expectations and be willing to properly educate yourself. If you don't, you will die. Okay, not really, but your account will die. Do you feel overwhelmed by all this margin jargon? Check out our lessons on margin in our Margin 101 course that breaks it all down nice and gently for you. The number one cause of death for Forex traders. Think you know the do's and don'ts of surviving the Forex market? Put your knowledge to the test. Hello, my name is Leverage, now die. So, along with not understanding leverage, what is number one reason new traders fail? They are undercapitalized. The number one reason new Forex traders fail is not because they suck, but because they are undercapitalized from the start and don't understand how leverage really works. True or false, just because a broker may allow you to open an account with only $25, that does not mean you should. True. Most new traders who open a Forex trading account with the bare minimum deposit do so because they don't completely understand what the terms leverage and margin really are and how it affects their trading. What is leverage? The ability to control a large amount of money using none or very little of your own money and borrowing the rest. I think it looks at. The textbook definition of leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. For example, to control a $10,000 position, your broker will set aside $2,000 from your account. What is your margin? What is 2%? Margin is usually expressed as a percentage of the full amount of the position. What do you call the money in your account that is available to open new positions? Usable margin. Usable margin is the money in your account that is available to open new positions. You will get a margin call when the value of your losing position drops beyond your usable one, isn't it? You will get a margin call when the value of your losing positions drop beyond your usable margin levels. Which of the following statements is true? Balance is used to determine usable margin. Equity is used to determine usable margin. Balance is used to determine used margin. That's definitely not true. It's equity, isn't it? Determine usable margin. Your usable margin will always be equal to equity less used margin. Therefore, it is the equity, not the balance, that is used to determine usable margin. Your equity will also determine if and when a margin call is reached. Your equity falls when your trade goes against you. Your equity falls when your trade goes against you. What is the advantage of trading on margin? It increases your buying power, right? Trading currencies on margin lets you increase your buying power. What do you get when your margin deposits fall below the required minimum level? What do you get when your margin deposits fall below the required minimum level? You get margin call, don't you? Margin call occurs when your broker notifies you that your margin deposits have fallen below the required minimum level because an open position has moved against you. True or false, your broker cannot liquidate your account before giving you a margin call. False. Your positions could be partially or totally liquidated should the available margin in your account fail or fall below a predetermined threshold. Which of the following statements is true? If a 1% margin is required, you have 100 to 1 leverage. Your leverage ratio depends on the value of your total losses relative to the amount you deposited to your account. Maximum leverage is the same as a true leverage. That's not true. If a 1% margin is required, you have a 100 to 1 leverage. Leverage ratio depends on the margin required by the broker. For example, if it's a 1% leverage is required, you have 100 to 1 leverage. What is the true leverage? The maximum leverage, not the maximum. Full amount of your total losses, nope. The full value of your open positions divided by the oh no. True leverage is the full amount of your positions divided by the amount of money deposited in your trading account. Oh, is it the second one? Oh, I should have read the second one through then. Fill in the blanks. The something leverage you use, the something breathing room you have for the market to move before a margin call. The more leverage you use, the less breathing room. The more leverage you use, the less breathing room you have for the market to move before a margin call. Why is it recommended to trade with a low leverage and ample capitalization? Your losses are very small. Low leverage with proper capitalization allows you to realize losses that are very small, which not only lets you sleep at night but allows you to trade another day. Which of the following statements is not true? The maximum amount that you are allowed to lever is dependent on your margin requirement. Is not true. Your leverage increases along with your account balance. Leverage is how many times you lever your whole accounts. Is not true. That's not true. As your account balance shrinks, your leverage increases. As your leverage increases, the faster your transaction costs eat away at the little money you have left. Fill in the blanks. The something your leverage, the something your transaction cost is the percentage of your trading capital. The higher your leverage, the higher your transaction costs. The higher your leverage, the higher transaction cost as a percentage of your trading capital. Which of the following is the reason why using huge leverage appeals to so much to new Forex traders? Leverage magnifies one's profits. The higher leverage is a favourite selling point for most Forex brokers. Yes, they pitch that you can make a huge killing using huge leverage, but also know that you could easily be killed by huge leverage as well. True or false? The more you trade, the less your broker makes on the spread. False. Brokers want you to trade with a short-term mindset. They want you to trade as much as possible, as often as possible. It's the only way they make money. 1 or 2 pips are important to them. The more you trade, the more they make on the spread. Nice, 18 out of 19, very good. True leverage is the full amount of your position divided by the amount of money deposited in your trading account. Okay, yep. Okay. So that's done. Position sizing. So, now that we've learned the hard lesson of trading too big, let's get into how to correctly use leverage using proper position sizing. Position sizing is setting the correct amount of units to buy or sell a currency pair. Sizing is setting the correct amount of units to buy or sell a currency pair. Setting the correct amount of units to buy or sell currency. It is one of the most crucial skills in a Forex trader's skill set. Position sizing 101. Calculating position sizes, complex position sizing. Actually, we'll go ahead and say it is the most important skill. First and foremost, traders are risk managers. So before you start trading with real money, you should be able to do position size calculations in your sleep. Finding the position size that will keep you within your risk comfort level is relatively easy, and we use the phrase relatively easy loosely here. Depending on the currency pair you are trading and your account denominations, dollars, euros, pounds, etc., a step or two needs to be added to the calculation. Units, your trade. Now, before we get our maths on, we need 5 pieces of information. Account equity or balance, currency pair you're trading, the percentage of your account you wish to risk, stop loss in pips, conversion currency pair exchange rates. Easy enough, right? Let's move on to a few examples. So, of information are needed. So, account equity or balance. Currency pair you're trading. The percentage of your account you wish to risk. Oh, whoops, I shouldn't have done that. Stop loss in pips. Conversion currency pair exchange rates. Easy enough, right? Let's move on to a few examples. Yes, let's do that. So, calculating position sizes. To make things easier for you to understand, as usual, we'll be explaining everything with an example. This is Newbie Ned. Newbie Ned. Hello. A long time ago, back when he was even more of a newbie than he is now, he blew out his accounts because he put on some enormous positions. It was as if he was a gunslinging cowboy from the Midwest. He traded from the hip and traded big. Ned didn't fully understand the importance of position sizing and his account paid dearly for it. He re-enrolled into the school of Pipsology to make sure that he understands it fully this time and to make sure what happens to him never happens to you. In the following examples, we'll show you how to calculate your position size based on your account size and risk comfort level. Your position size will also depend on whether or not your account denomination is the same as a base or quote currency. If your account denomination is the same as a counter currency, Newbie Ned just deposited $5,000 into his trading account and he's ready to start trading again. Let's say he now uses a swing trading system that trades Euro USD and that he risks about 200 pips per trade. Ever since he blew out his first account, he has now sworn that he doesn't want to risk more than 1% of his account per trade. Let's figure how big his position size needs to be to stay within his risk comfort zone. Using his account balance and percentage of amount he wants to risk, we can calculate the dollar amount risked. So USD 5,000 times 1%. So he's got $5,000 in his account. 1% is he doesn't want to risk more than 1% of his account per trade. So $50. Next, we divide the amount of risk by the stop to find the value per pip. So $50 divided by 200 pips equals $0.25 per pip. Lastly, we multiply the value per pip by a known unit per pip value ratio of Euro USD. In this case, with 10k units or 1 mini lot, each pip move is worth 1 USD. So 0.25 per pip, $0.25 per pip times by 10,000 units of Euro USD divided by 1 US dollar per pip. So all that times by 0.25 USD per pip, which gets you 2,500 units of Euro USD. So Newbie Ned should put 2,500 units of Euro USD or less to stay within his risk comfort level and his current trade setup. Otherwise he'll be regressing back to his previous gambling self. Pretty simple, eh? But what if your account is the same as a base currency? So this is if your account denomination is the same as a counter currency. So not this, but this. How shall I write this down? So, is there a summary at the bottom? No, there is not. So, If account denomination is the same as the counter currency balance times by percentage of accounts willing to risk per trade equals, wait, no, dollar amount risked is equal to account balance times by what is it? This is the, if your account denomination same as the counter currency, dollar amount risk, I should call it dollar amount risk for now. Starts now. Next we divide the amount by risk. Next we divide the amount risked by the stop to find value per pip. Per pip is equal to so let's call it amount risked actually. Amount risked divided by the stop, so risks 200 pip per trade. Stop to find value per pip, yep. So that multiply the value per by no, in this case position size would then be equal to value per pip times 10k units of Euro USD, in this case value per pip by known unit per pip value ratio of Euro USD, $10k. Why is it 10k before? By gnome, so times by gnome, let's call it gnome pip, known units per pip value ratio of the currency pair being traded. So newbie Ned should put on 2,500 units of Euro USD or less to stay within his risk comfort level with his current trading setup, otherwise he'll be regressing back to his previous gambling self. Pretty simple, eh? But if your account is the same as the base currency, right, okay, so if account denomination is the same as the base currency. Let's say Ned is now chilling in the Eurozone, decides to trade Forex with a local broker and deposits $5,000 Euro. Using the same trade examples above, trading Euro USD with a 200 pip stop, what would his position size be if only risked 1% of his account? So, amount risked is equal to account balance times by percentage of account willing to risk per trade. So same procedure. Amount risked is equal to account balance times by percentage of account willing to risk per trade. Now we have to convert this to USD because of the value of the currency pairs calculated by the counter currency. Let's say the exchange rate for €1 is $1.5. Now we have to convert this to USD because the value of the currency pair is calculated by the counter currency. Because it's calculated with the USD. So we have to convert the euro to USD. All we have to do is find the value in USD. All we have to do to find the value in USD is invert the current exchange rate for Euro USD and multiply by the amount of euros we wish to risk. So, convert to counter currency. Currency pair exchange rate inverted times by amount risked. Next, divide your risk in USD by a stop loss in pips. So the value per pip move, value per pip is equal to amount risked converted to counter currency. So equals amount risked converted to counter currency time divided by stop. This gives Ned the value per pip move of a 200 pip stop to stay within his risk comfort level. Finally, multiply the value per pip move by a known unit to pip ratio, value ratio. So position size would then be equal to value per pip times by known unit per pip value ratio. So 10k, is it the same? 10k units of Euro USD over USD 1 per pip. Value ratio of the currency pair being traded. No value, no unit per pip value of the currency pair being traded. Yep. So to risk 50 euros or less on a 200 pip stop loss, 200 pip stop on Euro USD, Ned's position size can be no bigger than 3,750 units. So this is more compared to if he was buying it with euros, or if he was trading euros, or if his account balance is based in euros. There we go. That's the best way of saying it. Still pretty simple, eh? Well, now it gets slightly more complicated. Don't worry though, we got your back and we'll explain everything so it becomes as easy as baking a cake. Okay, I'm going to leave this episode here then. So in the next video we're going to carry on with position sizing, with how to calculate your position size in different Forex pairs and account currencies. So thank you all for watching, and I will see you all. Peace.